It seems that it was a very big surprise for most of the investor community yesterday. Interest rates now down to 5.75% from 6% previously. Were you part of the camp that did not suspect this move at all?
Thank you very much, first of all. Yeah, you're right. That was a surprise that came through. Though this is something that is not very much out of expectation, because we have seen that for the last 6 months, I think interest rates have been showing signs of edging up. And I think it was about time that something was to be done. I saw the announcement yesterday was touching on 4 things. The government borrowing program, there's the interest rate market, the credit markets, as well as the private lending. So I think it came at a time when it came in the right time. And I think that should be able to quell some expectation that interests have gotten out of control.
Well, it's quite fascinating, as you were saying, alluding to the fact that it seems that there was a lot of pricing in of a changing monetary policy stance to one of tightening. Do you think this is just about confidence going forward? And you know, we allude to the inflation figure as well, which is sitting at 4.5%, just below, if you think about the target of 5%. We've got inflationary pressures on a global level feeding through because of food and fuel. And it's interesting that the MPC note that was released yesterday says that they don't really cite any upward pressures to inflation.
I think that's too ambitious. I mean, let's be realistic. I mean, all across the world, I think inflation has edged up. Food prices all across the world has gone up. But 2 things I want to support the government on that is, I think in terms of preparing the economy for the takeoff of inflation and probably interest rates going up, I think that was necessary. But in reality, I think the rate cut was targeting 2 things. One, we know very well the government borrowing program is just right on track, but not ahead of the track. We were looking to borrow 120 billion. And as of the close of the half year in December, we had only borrowed 59.6 billion, which is just about 50%. And the intention was to borrow about 90 billion. So which means from the intentions, the government is lagging behind the borrowing program. That's one. Secondly, there's an expectation that this particular year, probably this quarter or next quarter, central bank wants to do a 30-year paper. Now you realize to do a 30-year bond, you must have an interest rate market which is very stable, and people's expectation is they are very much in line with the 30-year paper. So I think these 2 things are the ones that could have led to the cut of that rates, so that at least everything comes in place. So, and then thirdly, you know, with all this borrowing going around, I think there's been a bit of concern from the banking side that, look, for 6 months, interest rates have been showing signs of going up. So I think it's about time that banks are thinking of also trying to touch on the base lending rate, probably increase by 25, 50 basis points, so that they can compensate themselves for the kind of loans that they're getting from the government.
Well, let's touch on your second point there, and you're talking about the cost of government's borrowing and also talking about the lag in the bond market, that government still has to go to the market quite a bit. Do you think it was just merely a move to try and bring down the cost of borrowing?
By the way, that could be one, but see, the CBR has very little impact when it comes to the government borrowing program. I know it helps the banks, particularly on the window, when they're going to borrow their, on the repos. But when it comes to how the interest rates are determined due to the auctions, it has very, very little impact. I think something that the government will have to do and keep doing probably in this quarter, if they want the expectation of the market to come in line with the expectation of government borrowing is not to change the rates. Maybe they may have to come and pump a lot of cash on the short end toward the reverse repos with a bid to make sure that the market is liquid enough all across, so that the overnight does not go up, as well as banks are forced not by circumstances to go for the primary auctions at rates that are very comfortable. But having said that, I think there's still a bit more of a challenge, because most of the debt that has been issued out there it's not doing pretty well, because I think the interest rates have slightly moved up, and the yield curve has made them not be able to be offered in the market and be sold. So there's still a bit of uncertainty to where the rates are going. Those central banks want us to believe that things are good.
Yeah. Well, Fred, I mean, one of the interesting things that come through from developing nations is that even though you've got the likes of the repo rate sitting at 5.75%, banks are still lending well above the 10% range. You were alluding to the fact that retail banks are not really dropping their rates down as fast as many would like. Here in South Africa, as soon as the repo rate is dropped, then a couple of days later, the retail banks then align themselves with the drop in the interest rate environment. When can we expect to start seeing an alignment, if at all, in Kenya?
I don't see that happening around here because, first of all, I think the economy doing 6.1% in the third quarter, I think that's a good sign that with the expansion, there's going to be need for private lending and the credit markets are going to open up. So for one, I think that demand is going to make sure that there's enough demand to sustain the high rates that banks are charging, which is an average of about 13 to 18% for the loans. And then secondly, you know, this market is a little bit different from the other markets. So I don't expect banks are going to follow suit. Fact that the central bank has reduced the base the CBR to 5.75. In fact, I think banks are going to sit down and watch to see what's going to happen in the next 2 to 3 months before they can make a decision. Though this is a very good thing, but I don't think it's going to lead them cutting the rates. Yeah. In fact, one of the things that is going to really to make banks make a decision on whether to increase or retain or change the base lending rate is going to be how the government behaves between today and the end of the government year, knowing clearly that there's a bit of some money that they need to raise. When the supplemental budget comes through, we do not know how much is going to be borrowed from the system. Secondly, we know KRA has been lagging behind by almost 20% in the month of December in their collection for revenues. Yeah. So that's a factor. Then we have, you see, drought is quickly approaching around here, and I think the government will have to get involved themselves trying to provide food for where it's necessary. And I think these factors are not going to make it cheaper or easier for the banks to reduce the
Fred, you know, we're running out of time, but just very quickly, on the global level, when we see growth rates of close to 7% expected into the fiscal year, and we also see a big threat of food inflation because of bad weather and global trends as well, some would argue that dropping rates under that kind of scenario is not very prudent. In your mind overall, would you say it's prudent, and would you say that we shouldn't be comparing the developed nations to the developing nations?
No, precisely. Let me tell you, no, it doesn't matter. Economics is the same. I think it's a little bit imprudent to reduce rates at a time when, first of all, you're expecting the demand for cash and for funds to go up because the economy is growing. So I think on that angle alone, it's not very much in line with the global trends. And I think whether we have good intentions of trying to contain inflation, I think inflation is likely to edge up because the cost of import bills is going to go up. I mean, fuel prices are already up there. Yeah. And I think with the other factors, it's going to be hard to maintain those kind of interest rates if the economy is going to grow.
Fantastic.